Hello all, and welcome to today's webinar. My name's James Gerrish. You joined the Market Matters webinar, Portfolio Positioning with Market Matters. We're going to run you through some of the our key thoughts on the market. I'm going to bring in Shawn Hickman very shortly. So my name's James Gerrish. I'm the lead portfolio manager at Market Matters and write a lot of the content. Present a lot of our views. So happy to give you or share some views on the market as we see it here and now. Stocks that we like, stocks that we're avoiding, the macro backdrop, and how we're approaching market. So there's a Q&A tab down the bottom. So feel free to ask questions throughout. We'll get to questions at the end of the of today's presentation. I'm going to kick off with some macro viewpoints, which Shawn is going to run you through some of those. Shawn's our research lead. I'm going to bring you in here, Shawn, so you can start your video and unmute yourself there. Thanks for joining us, Shawn.
Nice to be here, James.
So we're going to run you through some macro viewpoints around markets and why that's important in the way we're positioning for stocks. Run you through some of the stocks that we like, some of our higher conviction calls, how the portfolios are positioned. So it's all here and now, it's all live, it's all our views that we're writing about on a daily basis. And these are portfolios that we manage, we invest in, and we've got a fair amount of money behind them. So then we're going to finish off with Q&A. So thanks again for all of those on the line. We've got a lot on the line today. So really chuffed to have so many of you on board. Just to give you a quick background of myself and Shawn. So I've been in markets 20 years, managing portfolios. I manage discretionary portfolios for wholesale investors through Shaw and Partners, major shareholder of Market Matters, and an active investor. That's one of the main things. We put our money where our mouth is here at Market Matters. So Shawn's been in markets for 30 plus years. Goldman's, Macquarie, Market Matters, the other illustrious name in that list. So welcome, Shawn. He's got a real flavour for the macro standpoint, so we're going to get some of that today. So thanks for joining us, Shawn.
Nice to be here, James. Exciting day and fantastic to see so many people engaged. People must be enjoying the market.
Yeah, absolutely. We'll get to a lot of questions today as well, and I think questions are good. We get to provide a real life understanding of how we think about markets. So they're good. So you can put your questions in there. Just before we begin, a disclaimer: any advice today is of a general nature only. So you should consult a financial professional before taking any information on board. General information only. Just a quick rundown of our portfolios. So we actually run 5 portfolios on the Market Matters website. I've got 4 on the screen there. We've got a core ETF portfolio, which is a little bit more passive, that we only started about 12 months ago, that I haven't shown. The active growth is our flagship portfolio. So that's an ASX listed large cap portfolio actively managed for growth. Just to give you an idea, so that portfolio has done 13.2% per annum for the last 3 years. This is up till the end of April. If I look at so we track performance pretty closely. So obviously nearly 6% outperformance per annum. But to give you an idea of how that compares to other funds out there. So the Ausbil Australian Geared Equity Fund is pretty much top of the pops in Australia in terms of funds. They did 12.14% per annum for 3 years. There's the Airlie Shares Fund. They've done 9.71% per annum for 4 years. You've got things like Collins Street Value Fund, which is 7.72. So the index has done 7.3. The average fund manager in Australia, so our peer group in large cap land, has done 6.5 at 6.49%. A couple of other names you might be interested in. So the Montgomery Fund, Roger Montgomery, he's done 4.82% per annum for 3 years. Firetrail, Australian High Conviction Fund, has done 4.26 per annum for 3 years. Hyperion 2.2. So you get the sense of where we're going with this. We think our performance is strong relative to our peers. And the other thing that we do is we're completely transparent and timely in how we articulate what we're doing in the market. So the other portfolios give you a sense of how our national portfolio has gone, our international equities portfolio has gone, and our emerging companies portfolio has gone. And the core ETF portfolio has done 8.4 since inception. We're a top down meets bottom up investor. So what that means is we form macroeconomic views. So our big picture views have a bearing on how we position portfolios. We then look at the sectors that we want to be involved in, and then we dig into the stocks that fill that structure, if you like. So where we do a lot of quantitative screening as well as fundamental analysis, and then it comes down to portfolio construction, and we're high conviction managers. By that I mean 20 stocks generally in each portfolio, high conviction, active management, etc. And that's what's generated the outperformance that we've achieved. Now, that's probably enough from me, Shawn. Straight up around the macro standpoint, I've got 3 charts that describe the macro at the moment we framed this by. So take it away.
Okay, hopefully the subscribers that read the reports every day don't get too bored about me talking about bonds. I do talk about bonds, but hopefully this chart illustrates why. It's just going back a couple of years, but the correlation between bond markets and the ASX 200, stress I said the ASX 200, not individual stocks, is incredibly tight. Basically, that's because if you can have money in the bank earning 5%, the stock market's going to outperform it. Otherwise, people are going to have money in the bank. And this is why we need to know where the market thinks bonds are going, where the market thinks the RBA is going to act. That's only a part of the jigsaw puzzle.
Importantly, Shawn, on the chart there, so you've got in orange, that's bond prices. That's not bond yields. That's actually 3-year bond prices relative to the ASX.
Okay, thanks for that, James. Sometimes I get a bit ahead of myself. Exactly. So the higher the bond price goes, the lower the yield goes. Inverse correlation. I put the two there so the overlap is easy to see. What that does, that allows us to know which way the sentiment is swinging at the moment. We are in a very active situation. If anyone talks to me during the day or during the week, they know my mood swings are dictated by how the market matters portfolios go. And we're seeing a lot of sentiment swings around bonds, around bond yields. Only a couple of months ago, going into April, everyone thought we were going to get 2-3 rate cuts into Christmas, lay down misère, borrow money. Don't we have? It's going to get cheaper and cheaper and cheaper. Bang, through April, the complete opposite. Sticky inflation's here to stay. We might even get a rate rise in Australia. So these sentiment swings are having enormous differentials on the stock market, as you can see, and also more importantly on stocks and sectors. So for example, we bought JB Hi-Fi last week. We've been looking to pick up an exposure into discretionary retail, and that was our favorite, one of our favorite plays, especially with active growth as opposed to the income. And my decision then, I said to James, I think we've gone too far negative in terms of where bond yields are going to go. We had a spike down in the whole sector. Great, we'll finally buy a stock that we've been stalking for best part of 2 months. So those sentiment swings, sorry, 1 second. Those sentiment swings around bond yields, around sticky inflation, have an enormous impact on stocks and different sectors. Sorry, James.
No, just going to say cost of capital is really important. That's the key takeaway there. You'll see that there's a gap on the chart there between what the ASX is doing and what 3-year bonds are doing. So what we're saying there is we actually think bond prices will go up, pushing down yields, and that will again be supportive of the ASX, and that's why we've been maintained our a bullish bias, if you like. We think I guess the movement in April is one to fade, and Shawn just touched on one of the stocks we bought recently. We'll get onto those very shortly. He's jumped the gun a little bit there, but we will we'll get into how we're positioning around our macro views. The next one is around the tech index that you've got on the chart there, ASX 200 tech index versus the ASX 200 materials index. Tech has been more volatile than materials. What's your takeaway here, Shawn?
It's a couple of things. So it's really a follow on from what I was talking about, bond yields. If bond yields are low, interest rates are low, or the perception is they're going to be low, growth stocks, rate sensitive stocks such as real estate, such as discretionary retail tend to do better. And we've had a phenomenal move in tech at the moment. Over the last few years, the tech sector has had a fantastic time because the market is looking for rate cuts. It's got blinkers on it, saying we're going to get rate cuts over the next few years. It's already said we're not going to get rate rises, sticky inflation, doesn't matter. A spend a lot budget, doesn't matter. We're just kicking the can down the road. And the tech market is really flown out of the gate. Our view is, and we were very long that, it's one of the reasons we've had such strong performance across our portfolios is what we were heavily exposed to tech over a year ago. We said, right, Tech's bottomed. Rate sensitive stocks are looking good here, and tech was our preferred vehicle. Gets harder when you pick the stocks within that sector, but I think anyone will know most stocks in the tech sector have had a great 12 months. Go on, James.
No, I just think I think it's important also. I mean, technology, and this is one of the areas that not all boats move as one. So we're talking about we're talking about sectors here and how we position towards sectors. But you've got to be really diligent around what stocks you pick in individual sectors. So some material stocks have done phenomenally well, copper stocks, for instance, and some have done particularly poorly. The same plays out in tech.
Exactly, and that's where I was coming to. It's very much part of that bottom down meets top up. So the bottom down is we still think we're going to get rate cuts. We still think it would be supportive of tech, but as the previous chart showed, the market is now starting to factor in lower rate cuts. So we think the exponential gains that tech have had may be in the rearview mirror. They still look good. They still look strong, assuming you pick the right stocks, as James said. I mean, a great example. If you were long in the US, if you've been long, say Google, you've had a really, really good few years. But if you've been long Uber, or if you've been long Tesla, it could have been a very volatile, rocky journey. So you've got to pick the stocks in that sector, and that's our bottom up coming in. And especially in the tech market, of course, it's a bit trickier. It's fascinating, actually, really, really interesting. But coming back to the material sector, that has gone sideways for a long time. As James said, within that, everyone knows we've had great rallies in copper. We've had a shocking time in lithium. Aluminium starting to kick into play now. So we believe the materials index is going a lot higher. We actually think the gap between the materials index and tech will narrow, and we'll move on to this later. But again, within that materials index, which has gone nowhere, really, if we look at it, it's gone nowhere for a few years. You have to be very patient if you're looking for the next big move up. China's been very quiet. People have been very concerned, understandably, about the Chinese real estate market, but we think there's signs of improvement there, and certain commodities within that space we think are going to have a phenomenal few years. And so overall, as an index, as a sector basis, which is the next step down from the macro view, I think that materials will start to catch up to tech.
All right.
Does that make sense?
Makes sense. Makes sense. And then just following on from that, you've obviously got a chart of copper there. So copper's been on a tear recently, through $5 overnight, has been a phenomenal performer. Obviously linked to, so just from the outset, so materials are a positive view on materials. Obviously comes from the dynamics between supply and demand. So firstly around supply of materials, and then the demand side. We think the demand side is going to kick through from the energy transition. We think that's going to be a huge factor over the coming decades. And then supply side is really important. So supply in some commodities are low. So we see deficits out into the coming years for copper. That's why copper is prices have been strong, but the market underestimated the supply response in lithium. So lithium prices have been taken to the cleaners over the past 24 months. So those two factors are really important when you're thinking about what commodities you should be having exposure to and what you shouldn't be having exposure to, Shawn.
Yeah, exactly. Sometimes it's really, really boring investing. Supply and demand. Supply and demand will dictate everything. Whether a stock goes up by the weight of money, it's still the weight of money that will push the stock up day to day, week to week, month to month, etc. So with copper, I put this in there because it's had a tear. It's reached our original target of $5. We've had that there for all year. All year, I've said copper is going to $5. Oops, I've got the screen's gone white there, James. But it's very, very important. So I want to point out that that chart's already a day out of date. Did that on Thursday. Today we went through 500 or $5, depending on which chart you're looking at or how you're looking at it. I think this is just the start for copper. I think that supply-demand equation has got significantly further to play out. So sure, I'm sorry, James, will copper have a period of consolidation, a bit like it did in early 2024? Of course it will. But we're very, very reticent to lose our position exposure to copper. I wouldn't be surprised to see copper at 550 or 600 in the next year or two. Sorry, James, you were going to add something.
No, all good. So on the copper futures are in priced in cents, so that's $5. That's $4.81, and what it was trading at as of yesterday. Last night it went up and made new highs. So through that $5 US a pound mark in terms of copper. So just wrapping up our bigger picture macro views. So I'm going to get you a chart of the S&P 500 here, and then there's a chart of the ASX 200. Right now, markets are making new highs, or they're very close to making new highs. So things are pretty buoyant, and they're buoyant for a couple of reasons. So obviously, economic growth has been more resilient than many feared. We've got the expectation that rates will be cut. There's some machinations around when they're going to be cut, but ultimately interest rates will be cut. We've got really strong employment, and we've actually got the energy transition and a few other key sectorial trends that are going to drive demand for stocks, particularly in Australia. I think the what's playing out in tech, and Shawn made some really important points around the macro. So just to give you a sense of how market matters and we look at markets. So Shawn's very macro driven. I'm more focused on the stock base. Micro calls, so stock-based calls. So understanding the drivers of companies. So we bring our heads together and we formulate opinions around what we should do across our portfolio. So when you hear Shawn talk about the macro, very passionate about the macro, the rubber hits the road in terms of stocks. But I think one of the key things that sets us apart is around our macroeconomic analysis and how we spend a lot of time and a lot of effort writing about that on a daily basis and articulating our views around that. So I just want to get off the macro though, Shawn, and focus on stocks for a moment.
Absolutely. I think on that chart very quickly, I think everyone should take a deep breath and look at that. S&P 500 is basically at all-time highs. And if you think about the negativity that's crossed the press over the last year, whether it's the Russia-Ukraine situation, which obviously is much more than a year old, the conflict in the Middle East, etc., the fact that interest rates might not be cut this year like everyone thought, and here we are still at all-time highs. So again, simple supply and demand. The path of least resistance is up, as I wrote this morning.
I had a chat with a client yesterday just around, and one of the things he brought up was around US debt continues to go up. US debt, this should be a worry. Is the market going to crash, etc.? So markets are incredibly resilient. We look through a lot of these things. So the markets have a glass half full mentality. When they're going up, that can change. And that's why having your finger on the pulse is really important. So we don't get too caught up in the rhetoric that's coming to markets through the media. We get caught up in the views that we've formulated on a daily basis. So try and get the noise, put the noise to one side, and stick to your process is probably what I'd say. I'm going to bring you up the Market Matters website. This is the dashboard on the Market Matters website. Basically, it's your starting point in terms of when you come onto the Market Matters site and log in. We're going to go into our portfolio of the active growth portfolio. Just as a start, because we're going to focus on we've just spoken about copper. But I want to bring in one of our calls. So whenever you go into a portfolio, you get to see what the performance of that portfolio is updated on a monthly basis. The daily change in the stocks that we hold, that's updated every 20 minutes. So that gives you a live understanding of what our stocks are doing on a daily basis, and then an aggregate of those moves. So it's pretty clear. It's very transparent in what we hold, while we hold it. You can see the views around our portfolio positions underneath. And then if you want to dig in and do a little bit more research that we're going to do now on Sandfire Resources, you can click on the company code and dig in there and do some more analysis on a particular holding. So Sandfire Resources, copper company, $4.5 billion market cap. Everyone calls it sort of the premier copper company on the Australian market. Hasn't always been that way. Obviously, Oz Minerals was the premier copper company before it got taken out by BHP last year. We've bought it well, but we're going to continue to maintain the rage on Sandfire, Shawn. We both like that stock.
Oh, absolutely. I'm quite proud at the moment. I wish the year was ending today, because at the start of this year, first week on Ausbiz, they asked me, what was your pick for the year? And I said, for no other reason, the copper price, I've got to go with Sandfire Resources. I said, it doesn't necessarily is the best copper stock in the world, but if copper goes where we think it is, Sandfire Resources will have a great year. And I'm still sticking with it. You can't risk losing a position or exposure to copper, in my opinion.
So there's a lot of pushback on Sandfire as a copper exposure at the moment. So, and the reason for that is obviously around valuation. So everyone's, the on the site you can go and see what analysts are thinking about a particular stock. So, one sell, one strong sell, six holds, seven buys, one strong buy. So it's pretty much split. I mean, the price of Sandfire is just approaching $10 at the moment. It's 9.77 today and some change. What I think is important, and this talks to how we think about stocks. It's about what comes next, not what's gone in the past. So, Sandfire had an asset that they in WA called the Degrasser asset, which was basically a shorter mine life. They've used the funds of that to then expand internationally. They've expanded over in Spain, and they're expanding in Botswana in emerging copper area. So one of the things we like about Sandfire is the next couple of years they're going to increase their production by about 50% into a very strong market for copper. So I think that's what some of the brokers are underestimating at the moment. Jefferies have got $11 price target on it. They're the most bullish. Macquarie at 10.50, Citi at 7.90. But I think you've got we've held this view for quite a long time, Shawn. We're up 60% on the position, but we've got no intention of selling it at this point.
No, I mean, if we had 6%, you might trim it down to 5%. There's always ways you can play with numbers. But I read a report of one of the leading or largest, I won't use the word leading, one of the larger US houses this morning, and they've still got in their assumptions for copper stocks 440 or 4.4.
The,
And they're suddenly miles away.
Analysts are typically behind the ball on their commodity price assumptions. So when prices start moving on the upside, they will revise their prices higher and follow prices up, and vice versa on the downside. So whatever number you plug into your assumptions around the underlying commodity has a big bearing on the earnings of the commodity company that we're talking about. So Sandfire, these revenue estimates, these are all in US dollars, and this is consensus estimates, all available on the Market Matters site. You can go through the forecast tab, which give you some forecasts around for the next 2 years, what their earnings are likely to be. You can chart those on the site, etc., to give you an understanding of how they move. So it's a pretty cool feature. But I just caution that you've got to play eyes up footy, as I often say. So you've got to use some, you've got to have an understanding of what you believe the underlying drivers of those earnings will be and make some assumptions around that. So we like Sandfire, even though it's run really hard. Shawn, we're going to continue to hold it. What about elsewhere in the commodity space? So I was going to bring up another stock we own is Mineral Resources. So hasn't had a great last 2 years. The market has liked this over recent years. It's rallied off their lows, but what do we think about Min? Is it still something we want to hold on to?
Yeah, it was interesting. Again, we wrote about it this morning, James, as you know. I think we're at the situation where now we've held the position for over a year. Most of that time has been tough. We're now back in profit, but I don't want to take that profit. I know you don't. I think that the levers that have what pushed Min down was that the market was thinking it would have to raise capital. It looks
Well,
like they've come out the other end.
Chris Ellison's been very, very forthright in saying there's so many levers to pull in that business, they don't need to raise capital. So, one of the interesting things, so markets that you'll often hear from a commentary standpoint, everyone on the TV going about how do you approach markets, what stocks do you buy, and everyone talks about you've got to go out there and buy stocks with good balance sheets. Just focus on the balance sheet. I think we think at Market Matters there's so much more to it than that. Where you make money is trying to determine where the market has got it wrong.
Oh, exactly. And to me, investing is a bit like a jigsaw. By the time you've got all the pieces, it's too late. But you need to have enough pieces in place to make a sensible, informed risk-reward decision. One of the important decisions with Min is we got a lot of respect for Chris Ellison. He's been a very, very good CEO over the years. And when he says quite strongly, as you put it, James, that they've got all the levers to make sure they don't have to raise capital, you listen. This isn't Lend-Lease.
Well, you do, right? So, skin in the game. So Lend-Lease management doesn't have they don't own a lot of shares. Their alignment is not there. Also, you don't blindly follow, We do. We like Chris Ellison. He's got a great track record. He's backed his views with real hard dollars. He's, the major shareholder in this thing. So we like that, but we also have our own views around the underlying commodities they're producing. So they've got three divisions in their operation. They've got mining, they've got iron ore division, they've got a lithium business, and they've got a mining services division. So those, I think what they're doing is really smart. So the iron ore is a high cost producer at the moment, but they're expanding that to become a lower cost producer. They're using the free cash flow coming out of their mining services to fund developments in lithium and their expansion into iron ore, etc. So they're recycling capital very well. If they can get through this, if they don't need to raise capital now, when you think about where the lithium price has moved, that's a really bullish backdrop for MinRes. So I mean, when you're an owner, you don't want to be raising capital at low levels. If you believe the share price is undervalued, don't raise capital, do other things. And that's what they're doing. So we continue to like Min.
Yeah, exactly. And coming back to the comment about Chris Ellison, yeah, he's just one part of the jigsaw puzzle. He's not the reason we buy the stock, but it is a positive piece, And we wrote today, all three parts of the business, I think, look good moving forward. And when lithium turns, this stock could explode.
So that's a good point around when lithium turns. I mean, is it going to turn? We had just to give you to be completely transparent on Min. So we bought it in March of 23, so over 12 months ago. We paid 73 bucks for shares. We're only up 4% as it's trading it now. We were down fairly materially, and we have added to it at lower levels. So we've been patient on this one. We haven't panicked and sold out of our position. And we think now when we're trying to present stocks that are worthwhile looking at here and now. So Mina is one of those. The other one is Pilbara. So obviously the lithium story has been a really tough one over the last 12, 24 months. Lithium prices down 80%. Importantly, we haven't held these stocks during that decline. We've bought them into recent lows.
Exactly. It's one of the reasons why getting lithium right saved our bacon, gave us a really good performance last year. We didn't wear some of the pullback in the stocks. We bought the panic lows. And importantly, we've gone to the quality end of the spectrum. Just, because we never know where the bottom is. No one picks bottoms.
And that's what do you get when you pick a bottom?
Exactly. It's in hindsight. So if you buy the stock that's making a profit, paying a dividend, you can be patient. If you're buying a stock that's having to raise capital and is in risk of going out the back door, and lithium stays down here for 2 years, some of them can be gone, can be swallowed up.
So Pilbara there. We also just bought Albemarle. So for those who look at international equities, we've got that from levels just a little bit shy of we're in the 120s. So this is the world's biggest lithium company, integrated lithium company. Does a bunch of things around the lithium space. So they believe that prices are going to go up from here. I know the lithium companies tend to talk their own book, so you got to take that with a grain of salt. But the market doesn't work at this current area. We've seen that a lot of companies are taking production or future production offline. They're not investing in new production, and there's no the remedy for lower prices themselves. That's really important. The same is true with copper. So when high prices are playing out, then that incentivizes new production to come on stream, etc., that may have been uneconomic at lower prices. So that's why commodities are cyclical. So it's something to certainly think about. So just summing up the commodity space, Shawn. So we still like copper, and we like lithium stocks at this current point in time.
Yeah, I would.
Fair to say.
Fair to say, but lithium is more of a strategic risk investment, higher risk, for want of a better way of putting it, whereas copper is a long-term mega trend that I think is fairly much in its infancy.
All right. We've got in our growth portfolio, we've got about 35% of our portfolio in growth in material stocks at the moment. The market is about 22, 23%. Yeah, it's X200 and about that. So we've got a major tilt around copper, around material stocks. So that gives you a sense of our positioning. The other theme we touched on earlier is that our expectation as interest rates will fall. So that's not consensus at the moment, this year at least, but we expect interest rates will fall. So, we're playing that through a couple of different themes. And this week, Shawn alluded to it before. April was a really tough month for interest rate sensitive stocks. Bond yields went up, interest rate sensitive stocks went down. That includes discretionary retail, that includes property, that includes infrastructure. Discretionary retail, Shawn, we bought a couple of stocks this week. JB
Exactly.
Hi-Fi being the first one.
Absolutely. We stood in front of the train. We missed the low by a day. This, in our opinion, is a top quality retailer. Everybody knows it. It got smashed a long, long way, in line with a lot of stocks in that 24-48 period. I think the stock will look really, really good over the coming year or two. And if rates come lower, it will be solid.
So when we make a change to our portfolio, so in this instance, we cut Iluka. There's a bunch of reasons why we cut Iluka. We became a little bit more 50-50 on it. We won't go into that right now. We made a small profit, 7.5% in Iluka. But more importantly, we put an alert out to buy JB Hi-Fi. We give the level that we're buying it. We give the portfolio weight that we're buying it, and we send this out in real time. So both an email and an SMS alert, which helps to give you a timely view around what we're doing in the markets. It's not about writing, what we did 2 days later and giving you a fictitious price. The price we actually put on the website is the volume weighted average price that we trade at during the day. So it's a fair and transparent price. And that's what we're all about here at Market Matters, providing a timely, fair, transparent view of our take on the market. So the other one that we bought, Shawn, and we bought this in our income portfolio, and we bought it.
Just one other thing there, James. Sorry to interrupt. Is that I used the phrase before. We were very much stalking JB Hi-Fi. We'd talked about it over the previous few weeks. It was on our hit list, and it was even mentioned on our hit list as the number one stock we were likely to buy. So very often, subscribers have a really good idea what's coming next on these alerts.
Yeah, as they should. So our thinking doesn't come from left field. It's not picking stocks sporadically. It's doing analysis, forming views, and then having a price that we'd like to buy something at. JB Hi-Fi, we'd flagged as a buy below 59. We actually got it around the 57 ish dollars. Super Retail was one that we flagged as a buy sub 14. We bought that at 13.97. The next day it was down 4%. So that wasn't a great one. They presented a Macquarie conference that, and they presented an outlook that showed a little bit of weakness in margins. That'll happen. That's what's all about. That's about trading real time and presenting trading ideas and investment ideas in real time. Super Retail is obviously they own Super Retail, Super Cheap Auto, I should say. They own BCF, they own Rebel, and they own Macpac, a really high quality retailer that has pulled back recently. So that's what we like. If you can go and do some charting on the Market Matters website, and if you look at the longer term time views around stocks that we look at, you can get the bigger picture views. One of the things we like doing is buying stocks in uptrend, quality stocks that are in uptrends that have a pullback for a particular reason. And Super Retail Group was one of those, Shawn.
Exactly. You identify the stock you want, you identify the level you want to buy it at, and then you lay a plan. And that's exactly what we did with those two stocks. Hopefully it pays off. It won't always, but if you've done your work, and there's a very corny phrase, but it's a very good one. Plan your trade, trade your plan. It's very, very important with investment as well. It's no different.
One of the other, just staying on consumer discretionary stocks, one of the other companies that reported really well that we own in our international equities portfolio is Yeti. So some question, our focus on international stocks as part of a sort of a domestic operation, and some may not look at our international portfolios. Some may only look at our international portfolios. The international portfolio has done 18% per annum since inception, well above its benchmark. It's a high quality portfolio of well-known global brands. So, but one of the things it does, it gives us an insight into how areas of the US are performing as well. So which is really important domestically. So keeping a handle on what companies like Yeti's a company that makes eskies, coolers, all sorts of things. It's a great company. We've owned it for about a year. We've remained really patient. We haven't made a lot of money out of Yeti, but they reported last week and the stock rallied 20% on the back of that update. It's a stock we really like here. And the trends they're experiencing in the US are now in their international business. So 19% of their sales came from internationally. That's an area they're growing. There's a lot of read-throughs and a lot of interesting things to take away for our holdings in other in other retail stocks in Australia. So we learn a lot from looking internationally, Shawn.
No, totally. And there's another point there as well. When you see a stock drift off, as obviously Yeti did, into its report, it means the market's building in bad news. When a market's building in bad news, the surprises are often up, as we saw here. And I think it is a very, very good read through for a quality operator. I stress that word again.
One of the things that we're talking about, so rates coming back. So one of the obvious ones is infrastructure. So APA Group is a core holding in our income portfolio. Again, it's been a bit of a struggle in recent times, hindered by rising bond yields, higher bond yields. It's a regulated utility company. It is a really interesting infrastructure stock that we like. So, we bought it at slightly lower levels, but we like it here. So APA Group would be one of those. I'm going to pause very shortly and get on. There's a bunch of questions to get across. So we'll probably do our best explanations answering your questions that we've got. We spoke about technology earlier on in the webinar. And I'll just bring it back to that. So, tech is a huge topic at the moment. I think in the next 10, 20 years, etc., it's going to continue to be phenomenally big. AI is obviously something that's garnering a lot of attention. We think what technology will have, it'll impact so many businesses on the ASX. An obvious one that we've got an exposure to is Goodman Group, property company, but is sort of lurching into the data center space. That's obviously had a big supporting factor of its share price in recent times. So that's a quality operator. So I guess we won't go into technology here. We've got a number of tech businesses in our portfolios. You can look at the international equities portfolio. That's probably where the majority of our tech is sitting. There's some really interesting businesses in there, as well as our growth portfolio here locally and our emerging companies portfolio. But it is a topic that we'll spend a bit more time on in coming webinars. Shawn, I'm going to kick off with some questions if I can.
No, absolutely.
I just want to first one from Greg. We've got. I'm not going to get to all of these questions, just so everyone knows from the outset. The first one's from Greg and is on uranium, whether or not we're still bullish on the uranium. We're early adopters of uranium call. Are we still bullish there? And after the sector's had a great run.
The answer is yes, Greg. We might have found ourselves being a bit too smart by taking profit when we did. We've been in a Paladin twice in the growth portfolio. These stocks are higher risk stocks in that they're not yet making a profit, paying a dividend. But we think uranium has got a big future, and into any decent pullback, and they do pull back, they are volatile. We will be looking to buy it back in for the portfolio.
We kept our exposure in the emerging companies portfolio in Paladin, Greg. So we still have some exposure. You'll see that it's trading at $16.49. So they did a share consolidation 1 for 10. So $1.48 where we sold is equivalent to $14.80. Just to give you like a quick backdrop of the uranium space. So you've got Kazatomprom out of Kazakhstan, major producer. Cameco, 20 billion odd market cap company over listed in the in Canada, major producer. You've got Paladin, which is about a $5 billion market cap, getting into production in their Namibian asset. We like Paladin. You've got Boss Energy, which is about a $2.5 billion market cap company from memory. They're developing an asset in South Australia. They're coming on the production soon. Then you've got the smaller guys. So Peninsula, I think that's about a $300 million market cap. They're a couple of years from production. Then there's what have I forgotten? Deep Yellow, DYL, is
Yep.
another one that's a couple of years out of production. So we like the uranium sector. We think nuclear power has got a big future. As Shawn said, a lot of these gains came very quickly. I think from memory, Shawn, we booked like
I think just looking at that chart very quickly while you've got it up there, James, there's 30% pullbacks in the last 12 months. It's volatile space.
Absolutely, absolutely. So uranium, we like it. Buying into pullbacks. Gold stocks. Julie asking, are we still bullish on gold? Shawn, what's your take here?
Yes, we are. It's very much in line with our view on interest rates. Gold's still knocking on the door of all-time highs. Where are we now? 2360. I just glanced over my Bloomberg. I could see 2,500 US dollars. It's a good example, actually, of top down meets bottom up. We've called the gold price very, very well, but at times, evolution has frustrated us. It's been one of our picks, but still, I think we're going to see that stock make new highs this year, and we might take some off the table because it's not always operationally perfect.
Well, everyone said, you look historically and you don't hold evolution coming into a quarterly. And the proof has been in the pudding there. Obviously, they've had some operational issues. They're focusing on that. They've got a couple of assets that are a little bit more complex in nature, but I think they're addressing those pretty well now. So I think Evolution, the other important thing is that Evolution is a true copper gold company now. So, 30 to 40% of their earnings are going to be dictated by copper, which is a real win. So if we're looking at it as a copper company, it's not just a gold company that has copper credits. It's a true copper gold company. Down here at these levels, the risk reward really stacks up. So we continue to like Evolution. Incidentally, at their last operational update, they did pretty well. So they've cast, the market got left with a bit of egg on their face, Shawn.
It's also one of the reasons, because of its copper part of the business. It's one of the reasons why it's very easy for us to hold this stock into pullbacks. And we really would only, unless something really left field happens, we really would only consider taking a bit off the table if it had an aggressive move up through $4. And I mean aggressive.
So yeah, the market's pretty split on this as well. So 5 sells, 3 holds, 6 buys. So the market's more it's about in the hold camp, right? But there's still enough negativity in the market by analysts that when they deliver, when they execute better on their plans, that there's buyers out there for the stock to push it higher. When you've got everyone universally positive on a stock, there's no natural. There's the next buyer. It's hard to identify. So we actually don't like buying things that where the market is totally universally bullish on a stock. We've got okay.
Which is
So Robert,
also one of the reasons why we took a step backwards in the lithium space over a year ago.
absolutely, everyone was bullish on lithium, ESG, EVs, etc. Were going to be the thing that will underpin ongoing and insatiable demand for lithium. There is always a supply response in commodities. It's worth noting. Bob is asking around BHP. So where would we be buyers of BHP? So obviously a lot of news flow out of BHP. They've had a second tilt at Anglo that's been rebuffed. Anglo have now set forth their strategy moving forward. Looks very similar to BHP. What's your take here, Shawn? I've got a few views on this as well.
I really like BHP as a company. We've been saying for a long time if it dipped down to $40, we'd buy more. My gut feel is now we might have to pay more. So right here, right now, let's wait and see how the Anglo thing plays out. As long as they don't overpay for it, I sort of don't mind the move. But I'm a bit more 50-50, especially at $44.30. I'm more 50-50. We're long BHP. We're very happily long BHP, but would only buy a bit lower.
Well, yeah, so we'd add to our position a bit lower. I think we'd, if we didn't have a position, we'd be accumulating at these levels, looking to, buying BHP at the bottom of the range, I think makes sense. I think for me, if I'm, having a stab in the dark, I think BHP will probably do a one and done, best and final offer for Anglo, slightly above the price that they've put forth at the moment. When you do a best and final, you cannot bid again for another. I think the rule's around 6 months. There is a rule there in place. Don't quote me on that, but it's around about that level. So I wouldn't be surprised. The fact that they didn't say in the second bid, best and final, There is some legal connotations around that terminology. So I wouldn't be surprised to see BHP do one more. And if that's not, doesn't get the ball over the line, then I don't think the deal will happen. So that might be the catalyst to push BHP slightly more towards $40, and then that would be the level to accumulate. If they walk away from it, we think BHP ultimately is an accumulation at these levels, all the same. So it's pretty much we like it, we own it. We'd add to it if it dipped again. If we didn't get the chance to add to it, so be it.
And also, I'd say around here, we saw last night people were starting to take profit on Anglo American and put some money into BHP. You know, it
Yeah, it makes
was,
total sense.
yeah, exactly. I think right here, right now, I'd rather own BHP than Anglo American.
I mean, it's a hard like the BHP management, Mike Henry, etc. It's a hard sell. They're basically saying to Anglo, we can do better with your assets than you can. So we've got better execution operationally than you have. We've got a better track record. You've stuffed these up. Why don't you sell them to us? So obviously that's a pretty bitter pill to swallow from Anglo's management team, but they'll probably swallow it. It's, if the price is right. Morris here is talking about my top picks are Mineral Resources and Goodman. Well, we like those too. We own Goodman and we own Mineral Resources, so I'll take that as said. I currently hold a small holding in Sandfire. What's your accumulation level in Sandfire? That's a tougher one. Accumulation level in Sandfire, Shawn.
I think Samphire, you might well get some under 950.
I mean,
I would.
that's
It's not far away at all.
no, that's yeah.
But I don't think you'll see $9.
All
So
right.
I think I'd be accumulating. If we didn't have a position in Samphire, I'd probably be buying a third here, looking to buy a third into weakness.
Yeah, it's a hard one it is a hard one because it is like we like buying when the risk reward stacks up. So obviously Sandfire's making new highs, yada yada yada. It's continued to defy the anyone saying that it's not worth what it's trading at the moment. So I look at Freeport, one that we have in our national equities portfolio, again making new highs. So it's bullish, and you've just got to continue to back that trend. Do you have to pay? You have to pay subs to put money into an active fund, So I'll take that as, do subscribers need to pay to put money in the active fund? You pay 85 basis points per annum. That's it. So 0.85% if you want to invest in our Market Matters Invest fund. So these portfolios are open for investment from 25,000 or more into active growth portfolio.
I think the question might have meant you have to be a Market Matters subscriber to invest in Market Matters Invest. If that was where the skew was, the answer is no. You can just be an investor in Market Matters Invest.
Thanks, Shawn. Perfect. 25,000 is the minimum investment in the growth fund. There's a lot of questions there. Okay, so do you think SFR will recommence paying a dividend anytime soon? So yes, they will. So it won't be this year, potentially next year in terms of SFR's dividends. You can actually go onto the site. I think it's got it. So on forecast for Sandfire, yeah, I'm in there. So dividend per share, yeah. So there is a small one in 24 estimated. Doesn't really make sense when they're making a lot of spending a lot on new developments, and then in 25 that ticks up. So this is consensus expectations. So that answers your question. Jump on. There's a heap of info on the Market Matters website. I can't stress that enough for subscribers. Many consumer discretionary stocks still seem high versus historical values given the softness in demand and a high for longer interest rate expectation. What gives you the confidence to buy now? And at what point would you top up or cut and run? That's on super retail. So these have come back to historical averages from a PE point of view. Their multiples expanded a lot. So super retail topped out around $17. It's come back to below $14 now. We think the risk reward stacks up at that point at that level. We're wrong if more around super retail's margins. So super retail have continued they've got this operational efficiency program in play, and that's having an impact on their gross margins, which have been expanding. We want to continue to see that expansion in gross margins while the top line is continuing to grow at, low single digits, but then that operational leverage that kicks through operational efficiencies improves margins and profits grow more than the top line. So more around that. So the fundamentals of the business. So we like where they sit from a macro standpoint. We like the business, and then we need to keep a handle on how the big business is progressing towards its objectives. Hope that answers the question. WiseTech has run hard. How do you pick an entry point in the WiseTech? Shawn, this is obviously WiseTech has absolutely shot the lights out.
Yeah, it's a fantastic company. It's got revenue, the logistics company. Where would I, you're asking me where to buy. It does and has over the almost every year for the last 5 years, pulled back by over $20. Right here, right now, anything back around 98% lower, I'd be putting my hand up. I wouldn't be chasing it above 100. So these are technical views, I stress, not fundamental views. But again, it's a volatile stock. If you buy it right here, right now, you've got to be prepared to be down 20 or 30%. And really not a lot has changed in terms of the business.
Yeah, I couldn't agree more. So I'm not a buyer of WiseTech into new highs. I'm a buyer of pullbacks in really strong trending companies. And when I say strong trending companies, I mean that from a share price perspective as well as from a business operational perspective. The other thing I'd say is I challenge anyone out there to really pick apart the WiseTech business. So when you make so many acquisitions over a really short amount of time, the accounting becomes really challenging. Like I like looking at the balance sheet and the activity of a business, but when you get into the accounting nitty and gritty, it's really tough for WiseTech. So I don't have a huge amount of confidence on that, but the trends are there and they've executed, so it's hard to argue with it. Moving on, so buying pullbacks in Whitehaven, Ivanhoe Copper. I actually don't know Ivanhoe. Shawn, do you?
No, I don't. It's not a stock. I'm having a very quick look. No, I'd be same thing. I'd be following the copper price. I think the copper price will have a $30 sort of $3 rotation, I should say, at some point in time. Copper pulls back 5 or 8%. Any copper stocks to do the same, I'd be accumulating them.
So just someone asking about our forecast, our database. So what feeds into our database? So that's coming from, it used to be known as Refinitiv. It's now the London Stock Exchange Group. So the consensus data. So if you go into a stock, so WiseTech, for example, you look at how many, overview. You look at, so there's analyst cover. So there's 1, 11, 12, 18. So there's 18 analysts showing their forecasts to LSEG, and then consensus is the aggregation of those forecasts. So that's what consensus gives you. So there's a pretty, it's big. So that's what consensus is. So we certainly have not. We think that data is better than. So we looked at all sorts of data vendors, and we concluded that despite the exponential cost of LSEG, that we would go for the one that had the best depth, the biggest depth, the most well credentialed, and the broadest. The breadth of data, because we wanted international as well. We think that's really important. 88 has had a good pullback. What do you think of its current value? I was talking about, Harry's not on this call, but I was talking about with Harry, which is it's 88's in his emerging companies portfolio. And the pullback has been pretty deep. There's no two ways about that. This is a stock that I think we're up over 100% on it at this current point in time. So it's been really good for us, but the risk reward to me looks reasonable. Shawn, Ordinate, just from a technical standpoint, if you can.
Technical
looking
standpoint,
at levels.
Yeah, I think you could definitely throw a third to half in here, leave some ammunition in case it goes back to that $15 level. I like it.
In a general sense only. So we own this stock. So we own WiseTech. When we speak about what we're doing, it's what we're doing in the market. So I just want to stress that point. One of the things that you can do on the market website, you can see the history of our calls. So you can, whenever we write about a stock, it goes on the stock page. whenever we have an action on a particular stock, it goes on the decision tree. Then you can go back and read the opinion that we wrote at the time. So, transparency is really high up on our agenda. So I just wanted to stress that, and it's probably worth going back on the Ordinate side, looking at how we've historically thought about that business. Audio, it's a great business. Followed it for a long time. Know the management team really well. More questions. So, where are we getting? You've said that you sell XJO, XRO close to $1, $140. As with WiseTech, I find it hard to value Xero when EPS is 250 and P of 50, although growing. When do you ignore reinvesting in the business at a cost to get the real PE? Also, an argument when. Okay, so this is basically how you value growth stocks. So if you can invest $1 and get a higher level of growth internally within the business, that's what you should be doing. So that's what a lot of these growth stocks are doing. So if I can take $1 and generate 30% on that dollar internally, I think that's a good use of capital. So obviously, what happens when that plays out, and this is a byproduct of this, what you get is companies thinking that they're going to get 30% on every dollar they spend, but they end up chewing up a lot of the dollars. They throw money or they throw something against the wall and it doesn't stick. And that's, that companies used to get rewarded for doing that, and now they're not getting rewarded for doing that. So capital allocation is has changed in the or the market's view of capital allocation has probably changed a little bit in the last 12 months. Shawn, have you got a view on Xero at the moment? We did write that we were going to sell it above 140. It nearly got there. It's now back at 120.
No, I mean the same thing. I think it's in that space. If and when I feel the tech sector gets a bit overcooked, I'll be back on the phone to you, James, or sitting down with you with a pen and paper, and Xero will be a stock I'd consider taking profit on. But right here, right now, I'm comfortable to hold it.
Alrighty. In terms of what other questions? So Ron wants to know why we trimmed a hybrid in the income portfolio this week. So we trimmed go to the income portfolio. We trimmed the NAB, a NAB hybrid. So we sold out of the NAB hybrid. It's been in the portfolio since 2019. And is this a broader reflection on our view of hybrids? So NAB PF sold it on that date, 104, 106.46. So basically the relative valuation doesn't stack up. So NAB hybrid was trading on a margin of 1.2% over bank bill. NAB has released a hybrid subsequent. We didn't know they were going to do this, but NAB has subsequently launched a new hybrid this week, paying 2.6% over the 90-day bank bill. That is the tightest spread since these new Tier 1 Basel instruments have been put in place. I think it's about 13 years. So I've never seen a tighter margin. So hybrids so the prices have gone up, the yields on them have contracted, or the spreads have contracted. And that's because banks have got a lot of capital on their balance sheet, so they're safer. So you get a lower return for a safer investment, and that's why the return on hybrids have declined. We think on balance that we had a lot in the hybrid space. We've still got some in the hybrid space. We had a lot in the hybrid space in this portfolio. That it was time to trim it. So that's the reason why we did that, Ron. Is it a sign we're negative on hybrids? No, we just think the relative valuation has got less compelling in terms of that one.
There's one thing I would add to that, James. It's slightly at a tangent, but we might have 4 stocks that go close to our targets, a bit like a gentleman mentioned before with Xero. And we might be getting negative on the market, but we still won't really want to go any more than 15, 20% in the cash. So we're not going to sell all of them. We'll just, when we get a bit negative on the market or a bit concerned on the market, we'll trim some or take 1 or 2 off the table. We don't go 100% into cash. So we're not necessarily going to sell all the stocks just because half of them have got to our target area.
All right. In terms of, so coal stocks was one. So this is one we've been, we're, regular viewers, listeners, etc., would know that we like coal stocks. We think this is another way of playing the energy transition. So that might be a little bit strange for people hearing it first of all, but the rationale for owning coal stocks is that the energy transition is going to take longer and cost more than anyone expects. Coal's going to continue to be an instrumental component of that. Particularly met coal, so coal used in steel making. You can't make a wind turbine without steel. You can't make a lot of things without steel. So, these things are going to continue to be supportive. And the other important thing is you can't build a new coal mine. You can't get permitting, you can't get financing, et cetera, et cetera. So, there's a lot of reasons why we still like coal, particularly coking coal. New Hope is more thermal coal. We still like it because it pays a better dividend, and it's in our income portfolio. But Whitehaven, I think, will prove that this acquisition that they made from BHP is a good one. Have you got anything more to add, Shawn?
No, I just think it will be a cash cow again, but not for a few years.
Yeah, they're gonna. Yeah, I couldn't agree more. So, update on timing of Market Matters international portfolio. We've had some positive developments on that in recent weeks. I don't want to give you an update on that because I want to be able to announce that we've launched something. So, we are making progress on that. What else have we got? View on Perpetual. Darren asked. I'm happy to take that one, Shawn. But here's one. Does Shawn have a view on the banks, buy, hold, or sell, and which one? Asked Debbie.
Oh, hi, Debbie. I think around here the banks are a cautious buy. We are long ANZ and NAB. Not
What's
really
a
thinking.
cautious buy, Shawn? That's
A
sitting on the
cautious
fence,
buy.
mate.
Well, I know that's not my normal way, but I don't. Okay, I don't want to buy any more. I'm long
Okay.
ANZ. I'm long NAB. I'm watching ANZ carefully because, of course, they've got some work to do with the Suncorp, accumulation. They're paying a good dividend. No interest in selling the banks we've got, but I think they'll rotate, as I've said over the last few weeks in the reports, plus or minus a couple of dollars from here, plus or minus 5 to 10%. Why sell them? They're paying a good dividend, but would I chase more here? No.
All right. So
I
just
got off the
like
fence.
my view on got off the fence. So my view on the bank. So I think ANZ's probably, if I look at the recent bank updates, so we had half yearly updates from NAB, ANZ, and Westpac, and a quarterly trading update from CBA. Best update was from Westpac. They're making the best progress in their business. ANZ has been really aggressive in going after market share. That's had an impact on margins, and you overlay that with they've got to integrate the Suncorp Bank. I think that creates some risk in ANZ. We own ANZ in our growth portfolio, I'll just add, but we're conscious of that. CBA, best bank out there. We own it in our income portfolio. So expensive, but just tying back into technology and technology impacting every corner of the ASX, banking is going to be driven by technology. CBA has invested the most in technology. They've got the most to gain from improving AI and all of that they've been developing for a long time. So CBA, I think, is the best bank, most expensive. But I actually think it's justified to be expensive. It justifies its level. We're going to wrap up very shortly. There's a question just quickly on Magellan. Would we be a buyer here? We've got this stock in two of our portfolios. It's come back to what we think is a reasonable accumulation level. We like it here. Shawn, anything more to add?
No, I'd be very comfortable buy around here.
One of the things, this brings into another question. So Charlotte's asking about Perpetual. What's our view around Perpetual? I mean, what they've done, Perpetual they've basically done a deal with KKR to spin out to sell them their trust business, their wealth business, spin out the funds management business under a different brand separately. I think, the stock I think is trading at sort of $22. I might be wrong here, but around $22.
22.30.
Yeah. So they had a bid on the table from Soul Patts, I think $27. They had a bid on the table from Regal above 30. Those bids were to separate the trust business, sell that off, and take apart the business, but realize value that way. I think what Perpetual has done is pretty poor. They came to market. I was on the call when they were presenting it. They had very little clarity around how capital gains tax was going to be accounted for with the ATO. They had little to tell us around how debt was going to be hived into what area. It's not going to be in the funds management business, but it's going to be elsewhere. The Perpetual brand is going to go. I just think it's a uh, I liked it. I thought there was value in this perpetual business because of the trust and the wealth business, but what they've done, I think, is pretty poor. So I think it's just all too hard. I I looked at it at the start because I think there's value there, but I think it's all too hard. So we don't
Yeah,
own perpetual, we own Magellan.
yeah, and that's exactly what I was going to say there, James. It's too hard. There are 200 stocks in the ASX 200. When something like that's going on, you don't need to play it.
I think there's about 201, to be honest with you. I
Well,
think at the moment. Anyway, okay, so whoops, I've just gone out of the presentation.
as everyone can see, James likes boats.
That boat's actually got a Yeti esky on it, Shawn.
There you go.
All right, so we're gonna wrap up there. We'll thank everyone for your time today. We like presenting these webinars. We love the engagement that we get from our subscribers. We do a weekly Q&A report, so that goes out on every Saturday morning. So we had a lot of questions every week from subscribers. We come back to you with honest, truthful responses around what we think of an individual stock, what we're doing in the market, what we think about the broader macro view. Subscribers can ask about stocks that we don't own in our portfolios. If we don't know about it, we won't be able to answer it, but we'll do our best to put something together. ETFs, etc., can also be asked in this weekly Q&A. I'll draw your attention. If you are a member, thanks. We love having you. Look forward to having you for many years ahead. If you're not a member, think about it. There'll be a lot of offers coming through to you from our sales team over the course of the next couple of weeks. Consider it. We hope you'll join. We've got a growing community that we get a lot of really positive feedback. One of the areas you can see the feedback that we get is through the Q&A, weekly Q&A, where subscribers can pen their thoughts, etc. So thanks to all of those members. Thanks for joining today. We had a huge turnout. Anything else to add, Shawn, or I've just about summed it up?
No, just thank you. It was really, really exciting to see how many people turned up today. It's fantastic.
All righty. Thanks for joining. We'll end the webinar here, and we'll see you soon. Bye for now.